Every single day, the financial establishment pushes the exact same outdated narrative. Just dump all your cash into a low-risk, broadly diversified index fund like the S&P 500. Sit back and wait 40 years. But let's be honest. While the S&P 500 is a fantastic long-term wealth generator, its dividend yield hovers around a microscopic 1%. If your goal is to break free from the 9-to-5 grind and build a highly predictable passive income stream right now, a 1% yield simply isn't going to cut it. You'd need millions of dollars invested just to pay your basic monthly rent. Out of sheer frustration, most people run straight to the other extreme. They chase double-digit yields in things like volatile mortgage REITs or business development companies. On day one, those massive dividend checks look incredible, but they are often unsustainable. It's like building a mansion on quicksand. The moment the economy takes a downturn, those unsustainable yields get ruthlessly slashed, leaving your portfolio ruined. But what if you didn't have to choose between the painfully slow 1% snail's pace and the financial suicide of high-risk yield chasing? There is a hidden asset class that offers bond-like safety combined with equity-like yields and an automated vehicle that manages the entire process. Surviving the modern market requires looking past the binary choice between safe but slow and fast but fatal. The real opportunity lies in a specialized middle ground asset. To understand how this works, we need to look at the corporate capital stack. Think of a massive corporation like a layered cake. At the very bottom layer, you have corporate bonds. These are the safest, but they offer lower yields because the company is legally obligated to pay them first. At the very top layer, you have common stock, what most retail investors buy. It has the highest growth potential, but it's the most vulnerable layer because common shareholders are the very last to get paid if things go south. Right in the middle lies the sweet spot, preferred stock. It trades on the stock market like a regular share, but it behaves almost exactly like a corporate bond. It pays a fixed contractual dividend yield that is typically much higher than common stock. Seniority is a massive advantage for income investors. By law, a company is strictly forbidden from paying a single penny in dividends to its common shareholders unless it has fully paid its preferred shareholders first. On top of that, most high-quality preferred stocks are cumulative. If a company hits a rough patch and pauses its dividend, those unpaid distributions don't disappear. They pile up like a mandatory tab. Before the company can reward its common stockholders again, they have to clear their backlogged debt to you, the preferred investor. This structural design forces a company to exhaust its common dividend pool before it can withhold payments to this specific tier. It doesn't eliminate risk entirely, but it creates a legal priority that common shares simply do not have. Buying individual preferred stocks is difficult, as analyzing corporate balance sheets takes an immense amount of time. If you buy into a failing company, preferred stock can still expose you to total loss if the business goes under. Fortunately, there is a way to automate this process. While most retail investors buy passive index tracking funds like PFF, the smart money is moving into an actively managed powerhouse, the Virtus InfraCap U.S. Preferred Stock ETF, known as PFFA. This comparison shows why passive index funds often pale next to this vehicle. While standard ETFs follow a rigid index, PFFA is actively managed, pays out distributions monthly, and has a track record of outperforming the index. PFFA's manager, Jay Hatfield, runs a blocking and tackling strategy. Because the preferred market is filled with inefficiencies, the team can purchase high-yielding shares during new issuances, right before the massive passive index funds are legally forced to buy them, which naturally drives the price up. The management team treats this market like a predictable cycle. They buy undervalued preferred shares in rock-solid companies, wait for the market to adjust, sell them for a profit, and immediately recycle that capital into the next mispriced opportunity. The structural safety of the capital stack provides the foundation, but navigating these specific market inefficiencies requires a dedicated management team to identify and capture these pricing gaps. To be transparent, no investment is perfect. PFFA uses moderate, dynamic leverage to boost its yield. While the management team scales this leverage based on volatility, it does introduce an extra layer of risk during severe market liquidations. You might also see a high expense ratio on research websites. That number includes the interest expense required to run their leverage, an expense already accounted for by the yields of the underlying holdings. When you strip that away, the true management fee is under 1%. This brings us to the broader economic reality. As we navigate through 2026, the traditional stock market is looking incredibly stretched. Figures like Howard Marks and Ray Dalio have repeatedly warned that major asset classes are hovering in dangerous bubble territory. Recent data suggests the markets could be sleepwalking into a lost decade, a period where inflation-adjusted returns on standard growth stocks stay close to 0%. In a sideways market where capital gains vanish, cash flow becomes the primary driver of returns. When growth stocks stall, a vehicle that generates consistent distributions through contractual obligations provides a way to compound wealth that speculative stocks likely cannot match in that environment. This asset is not meant to be a single core holding for a hyper-growth portfolio, but as a reliable defensive cash flow generator, it offers a level of consistency that is difficult to find elsewhere in the market. If you want to learn more about passive income, please hit subscribe. As the macro-level market moves towards a prolonged freeze, constructing a micro-level high-yield fortress is a logical move to secure financial independence. Thanks for watching.